Hello and welcome to this week's podcast, brought to you by the Good Money Guide and our sponsors Pepperstone, who are a multi-regulated CFD broker specialising in trading services in forex stocks and commodities in multiple destinations. I'm Michael Hewson, and joining me once again is Pepperstone Senior Market Strategist Michael Brown, pretty much fresh from the latest Bank of England rate decision and press conference.
Indeed, yes. Very good afternoon to you, mate. And that is why I would imagine to our viewers and not our listeners, I'm looking rather haggard because it was a slightly shambolic and chaotic Bank of England decision this lunchtime, to say the least.
Well, I said I'd get the swear jar ready, just in case.
Well, put a tenner in there for me.
And I put an early deposit down already.
I think that's wise.
It's about 20 or 30.
I am slightly worried that the swear jar appears to be your back pocket. It looks like I'm just paying for a round for you later on, but never mind.
Oh, it's just a brown envelope, mate. Anyway, markets having set new records earlier this month. FTSE 100 is getting a bit of a shoeing today on the back of that decision. Stronger pound. There's splits obviously on the MPC. US markets doing slightly better despite a sharp sell-off at the end of last week in the wake of those non-farm payrolls numbers, which saw weaker than expected job numbers, but also some large-scale revisions to previous months.
Yeah, and I think the revision was the kicker last week. I said in my note on Monday morning, reacting to all this, we've all seen over the years non-farm payrolls numbers that come in surprisingly soft, and we can sit there and relatively easily dismiss that as a one-off. The problem with the July jobs report was you also had the prior 2 months worth of data being revised down by 250,000. So as near as makes no difference, the US economy, according to the non-farm payrolls data, which a certain someone believes is being politically motivated, hasn't added any jobs as near as makes no difference for the last 3 months, which really makes you sort of question how resilient things are and whether our assumption about the robust underlying nature of the economy is still correct.
Well, we'll dig into that in a minute after the risk warning.
Yes.
So, risk warning. The information provided here, whether from a third party or not, isn't to be considered as a recommendation or an offer to buy or sell, or the solicitation of an offer to buy or sell any security, financial product or instrument, or to participate in any particular trading strategy. We advise any readers, viewers or listeners of this content to seek their own advice. Spread bets and CFDs are complex instruments and come with a high risk of losing money rapidly due to leverage. 73.7% of retail investor accounts lose money when trading spread bets and CFDs with this provider. Okay, so basically Trump's fired the head of the BLS.
Yeah.
Because apparently the jobs numbers are politically motivated. Yet I didn't hear him complaining when there was an upward revision of 800,000 in August, just before he was elected as president of the United States, and which actually would have negatively impacted Biden's polling numbers.
Yeah, and this is the thing that frustrates me is, there are issues with data quality, not just in the States, but globally. I mean, look at the shambles that the ONS here in the UK have become in terms of the jobs numbers. And that rightly needs to be looked at. But the way you look at that is to conduct reviews, to increase funding for the BLS, not cut it as part of all your Doge efforts and all the rest of it. And certainly the last thing you should be doing from a credibility perspective is firing the chief of statistics there the day you get a non-farm payrolls report that you don't agree with. I mean, that really does raise some important questions going forwards. I mean, we're sort of getting towards a scenario where, let's say non-farm payrolls rises by 300,000 in August or whatever that number may be. We're going to have to look at that with potentially and take it with a pinch of salt, saying, can we really trust the data that we used to think was a gold standard? Is it still as reliable as it was? You'd like to think it is. You'd like to think these agencies can steer clear from political interference, but that may not be the case.
Yeah, I mean, you raised the issue about the Office of National Statistics, and I made that very same point in a comment that I'd made to S&P Global, particularly about this particular topic. The US issues around data collation are no different to the data issues that we have here in the UK. Yeah. And it would appear that the US and UK labour statisticians, or statisticians in general, are still living in the 20th century in an increasingly digital world. Anyway, before expanding upon that, let's look at what we're going to talk about this week, because there's quite a bit to get through. European markets having a slightly better week of it. Obviously, the EU and the US have extended tariff talks by 6 months. That's been greeted relatively positively, and that's essentially, I think, what's driving markets this week. Obviously, along with the tariff talks, so we'll talk about that. We'll talk about the Bank of England, the divisions there, the forecasts and what have you, the change in the forecasts of the August inflation report. More earnings. Another big week for earnings. We're going to talk a little bit about Amazon and Apple, recap them, because obviously they came out post our podcast last week. So dig into those numbers a little bit. And then we'll look at the numbers this week out of the UK, which have been a little bit of a mixed bag. BP, Diageo, IHG, Travis Perkins, WPP, Harbour Energy. And then we'll look ahead to next week's second quarter GDP numbers, the unemployment numbers, which are likely to point to a weak economy, and I think are a large part of the reason why the Bank of England cut rates today. So we'll talk about that. But before we start on all of that, a rare bit of good news for the UK stock market.
Yeah, why don't we start on a vaguely positive note?
Glencore. So they decided to stay in the UK. So I think in terms of signalling, that's very positive, particularly when you've got companies like Rio Tinto looking at potentially reevaluating its own UK listing.
Yeah, absolutely. And well, like I said to you a short while ago, it's a rare bit of much needed good news for the London market. We have spoken many a time about the number of companies that have been moving their listing over to the United States. And actually, it's a great relief to see that Glencore will be staying put. I mean, I suppose in one way we can call it a sort of green shoot of recovery, perhaps, and maybe this is the first of many that will make a similar decision. On the other hand, I think it speaks volumes about how far the London market has fallen when we're all sat here kind of going, "Oh, thank goodness they're staying." That we're almost just sort of avoiding that death knell as opposed to. It's not exactly good news they were even considering it in the first place. But it is nonetheless a relief that they are staying put. Although it must be said, I was reading a bit of research that the London Stock Exchange put out. Now, obviously, they do have a slight vested interest in this matter, which I think we should probably clarify first of all. But a number of UK firms that have moved over to the US, actually, it hasn't been the boon for them that you might expect it to be. So I don't know whether that has perhaps weighed on Glencore's decision-making as well. But yeah, it's good news, ultimately.
Yeah, well, they're also in the middle of a large-scale cost-cutting program. And I think they also looked at the costs of relocating and decided ultimately that it probably wouldn't unlock a significant amount of shareholder value to move the listing. That being said, I still think that Rio Tinto could come under pressure to move its primary listing to Australia. It is under pressure to do that.
Yeah, and obviously, BHP trod that path many years ago now, so it wouldn't be completely out of the question if they were to do that as well. But I don't think we should get ahead of ourselves. I don't think we can sort of sound the all clear on the London market, but it's better than it was. Let's put it that way.
Well, yeah, I mean, as I say, we've got a down day for the London market. Now that we're above 9,000, things are looking a little bit more promising in terms of valuations. And certainly, I think in the past 6 to 8 months, we've seen a significant improvement in valuations. So I think on that basis alone, maybe that is giving some companies a little bit more pause about whether or not to relocate, because ultimately the higher the valuation they have here, the less attractive it then becomes to potentially move to the US because the valuation gap narrows.
Yes, absolutely. And that is certainly something worth keeping an eye on, if and indeed when the market continues to gain ground.
Okay, let's move on.
That's
to
the good news over.
That's the good news. Let's talk Bank of England. Now, obviously, a bit of a contentious decision. We were discussing this last week. It's pretty much nailed on that they were going to cut by 25 basis points. The reality proved somewhat different.
Yes, exactly. Well, the reality proved that they almost accidentally ended up leaving rates unchanged. Now, what prevailed within the Monetary Policy Committee and their meetings, we don't know, of course, but we do know that the first vote they took on policy ended up with 4 policymakers preferring to hold rates steady, 4 preferring a 25 basis point cut, and 1 external member, Alan Taylor, preferring a 50 basis point cut, which meant that there was no majority for any outcome on the MPC, and it led Governor Bailey to recast the vote, which I think is the first time that's ever happened in the, well, getting on for 30-year history of the Monetary Policy Committee. And within that vote, Taylor decided to join the camp voting for a 25 basis point cut. So that is indeed what we got, a relatively hawkish vote. But then actually the BoE, I would argue, made something of a dovish change to their statement, because they removed this line around policy needing to remain restrictive for sufficiently long. So they're in a right pickle. They've also raised their near-term inflation forecast, but at the same time they've cut
by quite a significant amount.
Yeah, they think the peak's going to be about 4% now in the third quarter. But at the same time, they've lowered their view in terms of peak unemployment, which they now see at 4.9% compared to the 5% that they saw previously. So all in all, the MPC are in a right pickle at this point. I think the only good thing I can say about what's happened today is at least we won't be able to level any accusations of groupthink at the Bank of England for quite a while.
Oh, we haven't. I don't think we've done that for quite some time, and I think one of the key criticisms I had of the Bank of England under the Carney era was that it was very much groupthink. So yeah, by all means, criticise the Bank of England. At least there's a wide range of views. I think what was more surprising for me is they raised their GDP forecast.
Yeah, I didn't understand that either.
Which I just don't get. If you're predicting higher unemployment and higher inflation, why would you raise your GDP forecast? And I think more puzzling than that was Swati Dhingra. She's been consistently the most dovish member of the MPC for quite some time. And yet she was quite happy to vote for a 25 basis point rate cut. Now, basically, if I'd had money on someone voting for a 50 basis point rate cut this week, it would have been her.
Yeah.
So why did she not do that?
Well, I mean, it could well come down to what we were discussing just before we hit record. Was the discussion along the lines of there's no way that, the support for a 50 basis point cut isn't there. There are a number of people who want to hold bank rates steady. So, I'll vote for the magnitude of easing that I think will pass. Maybe that was along the lines of her thinking. I mean, the other interesting point in terms of the vote split is if you look at who dissented in favour of holding rates steady, arguably the two, and this is a point that our mutual friend Andrew Sentence made just a moment ago, arguably the two sort of policy experts on the MPC, the Deputy Governor for Monetary Policy, Claire Lombardelli, and the Chief Economist, Hugh Pill, they both voted for rates to be held steady, which I think is interesting, firstly, given their positions, but also considering that the core of the committee, they tend to vote as a block. The governor, his three deputies, and the chief economist, over the years, they've all tended to vote the same way. But very much over the last 6 months or so, even within that internal grouping, there have been some quite serious splits starting to emerge.
Yeah, I think it was interesting. A comment made to me on X earlier today by John Stepek was that they didn't want to move the base rate below the peak inflation rate into negative territory. I think they were concerned about doing that, which is why they've basically moved it to 4% and not to 3.75. You can't have a situation where inflation is actually, sort of higher than the bank base rate by year end. And their target for the end of this year is a CPI forecast of 3.8%. So how do you square that argument?
Well, one of the ways you can square that argument is by saying that the forecasts are usually pretty useless and likely even more useless this time around because they're based on a market curve that does this, and the market curve has repriced quite hawkishly. We've now only got about a 2 in 3 chance of another cut by year end in the curve, whereas before the meeting that was fully priced. So there is that to consider as well, of course. But what do you reckon? Because obviously I know we're 2.5 hours as we record out from the BoE decision. The dust hasn't really settled yet, but do you reckon, I've seen a few people say that's them done for the year. Do you agree with that? I reckon they might still go in November.
I think they'll go again. I think they'll have to go again because unemployment will move up towards 5% and the economy will stagnate. And that by those two metrics alone, inflation should come down.
You would expect so, yeah.
Because it will be a demand-driven decline.
Yeah, because that margin of slack that opens in the labour market means that demand will dry up. I would agree with that. I think there's a little bit of an overreaction around the vote split. I think fundamentally you need to look at the statement. gradual and careful is still there. The BoE imply from that they're going to cut quarterly. If they didn't want markets to price that, they would have removed that line, I think is how I would boil it down.
I mean, markets are pricing in another 2 rate cuts by the end of this year. I don't think we'll get them unless the economy really does nosedive. Probably get one more. But what you make of this statement?
Oh God!
Since the general election, interest rates have been cut 5 times and are now at their lowest level for 2 years, bringing down the cost of mortgages and loans across the UK. By bringing stability back to the country's finances, we're putting more money in people's pockets. What an unadulterated load of drivel.
Is that our esteemed Chancellor by any chance? That's the first time I've actually heard that. I hadn't come across, hadn't seen that.
Yeah,
what a load of nonsense.
She tweeted that, and I said, "Yeah, okay. Now look at gilt yields.
Yeah, look at gilt yields.
Where they were a year ago and where they are now. They're higher.
Yeah, of course they are. Or even look at swaps, which are higher, which is what mortgages are directly priced off. I mean, that's just complete and utter nonsense. And that's just gaslighting the UK population. Yeah, this is someone
utter nonsense. In fact, I'd use the B word. Apart from the fact that we're not allowed to. It's utter tripe.
It is.
Honestly.
But the problem is there's people out there who believe that, worryingly.
Well, sadly, I would have to agree with you on that. Anyway, so essentially the Bank of England is concerned, probably reading between the lines, that the economy is slowing and that inflation will hopefully come down all by itself.
Yeah. Basically, I think that's what they're hoping. I mean, I think, it goes back to that point around demand that we were just discussing. They're, I think, betting on the economy rolling over such that inflation rolls over with it. The weird thing is they're not actually forecasting that, even if it is their sort of unwritten, unspoken central assumption.
And the problem is you've got deteriorating public finances. You've got the potential for significant further tax rises in the autumn. And you've already got national insurance contributions and national minimum wage rises exerting upward pressure on food prices. So even if inflation does come down, it's not going to come down quickly because at the end of the day, you've got a situation whereby retailers and businesses need to, on some level, maintain some level of the margins they were getting a year ago.
Yeah, and I thought that was interesting, actually. They touched on that at the post-meeting press conference where Governor Bailey was saying that actually one of the sort of pass-through effects of the national insurance changes is showing up in higher food prices, not necessarily in terms of just the labour market weakness that we're seeing. It's that sort of dual shock of a headwind to the labour market, but also a tailwind in terms of pushing inflation higher, which is kind of the worst of all worlds, really. But I don't. The other thing with the BoE is what are they going to do with the balance sheet? I mean, they're going to announce that formally in September, but
are they going to stop QT?
Well, it would do Rachel Reeves a massive favour if they did, because that is one of the. I think they will. I think one of the issues that the BoE have, or it gives them a bit of flexibility, is they've been much more aggressive with reducing the size of the balance sheet than other G10 central banks because they've been actively selling off their portfolio into the market. Now, one of the issues with that is you're just crystallizing a load of losses that the Treasury has to indemnify, which is one of the reasons why we keep losing this fiscal headroom. But also, if you look at the long end of the curve, things are a bit shaky, to say the least. So I think at a minimum, the BoE need to cut or even end the process of active outright gilt sales. If they want to do passive runoff as things mature, then I think that's probably fine. But don't add to the pressure that's already there and risk, markets becoming dysfunctional.
Right. Okay. Well, so that's the Bank of England. Obviously, next week we'll be looking. When we look at the week ahead, we'll be looking at the second quarter GDP numbers, the unemployment and the wages numbers. We'll come on to that later. Let's now start looking at the earnings numbers. Now, Amazon and Apple. Little bit underwhelming, both of them. Seen a little bit of a sell-off in the wake of the Amazon numbers, but I think a large part of that was part and parcel of the fact that you saw a bit of a sell-off at the back end of last week anyway, on the back of those jobs numbers and Trump's firing of the head of the BLS. But I think there was some disappointment over their guidance because the actual numbers themselves were fairly decent. truth be told.
Yeah, I would agree with that. And I mean, I think, and we'll come on to Apple momentarily, but I think it's quite hard to get a sort of pure read on how the market has taken both of those reports, because there was so much else going on within
Yeah.
12 hours of them dropping the numbers. We had firstly the tariffs that actually went into effect for once. Trump didn't chicken out on the 1st of August. Then we had the jobs report. Then we had the firing at the BLS, as you said. I do wonder whether markets have become a little bit spoiled in terms of, we're so used to all of these mega cap names beating expectations, raising guidance by a fair chunk, that when that doesn't happen, you then end up seeing the stock in question get punished as a result, even though, actually, if you look at the figures, sales are up and well above expectations. AWS revenue is still performing very, very well indeed. There's not actually a lot to dislike about the data. It's just not meeting the very, very high bar that markets have set.
Yeah, I mean, the Q3 net sales forecast was still well above the numbers in Q2. We're talking $175 billion.
Yeah.
$177 billion is the midpoint for Q3. And Q2 was 167, which was still well above the $148 billion, the same quarter the year before. So certainly in terms of the Prime Day numbers and the consumer numbers, Amazon is still showing that the US economy, even if it is slowing, consumers are still going out and spending money.
Yeah, absolutely. And I think that's important, certainly in the context of the jobs data, where we kind of went, oh, maybe there are some cracks starting to emerge. Well, Q2, you'd arguably say the US economy added no jobs, but you look at the commerce earnings and the consumer discretionary earnings, it's all pretty rosy. So even if the labour market may well be faltering, the consumer is still spending. And if the consumer is still spending, that's going to power the economy ahead.
Okay, so let's move on to Apple, one of the worst performers, bar Tesla, in the Magnificent Seven year to date. I think.
Well, they were.
They were. Low expectations. Numbers are still pretty decent, though. I mean, when you look at the 94 billion in revenue, that's a record for that particular quarter. It's a 10% increase on 2024. Services revenue, another record for services. And I think that going forward will continue to add to the bottom line.
Yeah.
I think what was interesting was strong demand in Europe as well as the Americas. And I think a large part of that was perhaps because of people buying Apple products in anticipation that they would increase in price in subsequent quarters.
Yes, I think there may well be a degree of that going on. And I think, it's almost akin to that tariff front running that we saw in terms of corporates in Q1. Have consumers pulled their purchases forward a little bit? Because, ordinarily you'd say that the second quarter is a little bit slower because we're not far from new products being launched. The new iPhone will probably come in September. The other big thing that we saw in those Apple earnings is that sales in China are back moving in the right direction, and that's been a bit of a problem child for Apple in recent months, and they're now starting to pick up as well. I mean, you've written down here almost 5% higher in terms of iPhone sales. The big issue with Apple, though, is of course they remain, and this wasn't in the earnings report, they're never going to admit this, of course, but they remain so far behind in terms of AI compared to their competitors. And, yes, it was a solid set of figures. Yes, the share price has responded well, certainly since they pledged that investment in US manufacturing yesterday, on Wednesday, but they're still massively behind their competitors when it comes to the AI arms race, and they don't seem any closer to resolving those issues.
Yeah, we've seen a big jump in the last couple of days on the back of that additional $100 billion of committed investment into the US. I think it was $500 billion before that.
Yeah, so it's 600 yards in total now.
Yeah.
And obviously the key implication of this is not only are they investing in the US, but also it means that they're going to be effectively exempted from a number of these tariffs that have been put in place, most importantly on India, which is now subject to a total 50% tariff on imports into the States. And of course, Apple were planning, when China got slapped with tariffs, their plan was, well, we'll ship all our iPhones that we're going to sell in the US from India instead. Well, now India are being slapped with a tariff. So the fact that they've got a carve out from that is very important indeed.
Yeah, seeing the share price move up towards around about $220, right where the 200-day moving average is. It's bumping right up against that. So it'll be interesting to see whether or not it can break through that level. But that also happens to coincide with the highs that we saw at the beginning of April and the end of March of around about $225. So I think if we can really consolidate this move higher that we've seen in Apple and move through that 200-day moving average, we'll see a revisit of the highs this year.
Yeah, that's going to be the key level now. If we do break through that, then that's certainly going to massively tilt the momentum back in favour of the bulls and expect a bit of a more of a run higher.
Okay, all right. So let's move on to this week. We've seen a plethora of earnings out of the UK. Some good, some not so good. Let's start Harbour Energy, and we'll start with energy. Well, BP and Harbour Energy, might as well because it's topical.
Yeah, let's do them both together.
Slumped to a loss, did Harbour Energy, of $174 million, but the shares are up 8%. And the reason for that is a buyback of $100 million, but also because they've integrated the Wintershall Dea portfolio, revenues have jumped from $1.9 billion last year to $5.27 billion. And consequently, because they're less exposed now to the UK in terms of the wider business, there is a hope that this integration of these assets should help them spread the risk when it comes to the energy profits levy, which actually wiped out all their profits.
Yeah,
every last dollar.
Yeah, I'm glad you've raised that, because I think that just sums up the complete and utter idiocy of that policy from the UK government, which we could rant about all day, but we shan't. It's clearly a positive for the company that they've managed to diversify and integrate those assets so that this time next year it won't be so much of an issue. But the fact that that can wipe out the entire profits of a company is quite frankly ludicrous, and why any energy company would look at that and go, I'm going to invest in assets in the UK, it just boggles the mind.
They said in their presentation that the effective tax rate of the energy profits levy, because it was extended out to 2030, was 111%.
Yeah, I was going to say, it wouldn't surprise me if it was more than 100%, given the duration of it.
Yeah. So that means that their $1.6 billion profit turned out to be a $174 million loss, a $1.8 billion tax bill. So, and people wonder why people aren't investing in the North Sea. Well, there's your answer. There it is in all its black and white or HD, ultra HD quality, symbolism, utter idiocy from our Energy Secretary, Ed Miliband.
Yeah, and actually,
utter moron.
If I'm correct, and I'm just Googling to make sure I am correct, but I believe that actually the policy was introduced by prior government and a man called Rishi Sunak when he was Chancellor. So people on both sides of the political aisle have got this one terribly wrong. No,
a plague on all their houses. But the thing is, he only did it under pressure because from the Labour Party. I mean, that's the only reason he did it. I think if they'd been a true Conservative government, and I'm talking to the Conservatives about 20 years ago, they were considered a business-friendly party. Now, neither party I would consider to be business-friendly, a plague on all their houses. Anyway, let's not go down that rabbit hole.
Let's talk about, shouldn't.
let's talk about BP, because really positive share price reaction, I think, this week's to their Q2 numbers. But I got to say, I'm not impressed by them at all. But having said that, they committed to another buyback, $750 million, I think. And obviously, I think the numbers were overshadowed somewhat by the new discovery in Brazil. So I think there's potentially an element of that getting priced in. Because when you actually look at the numbers themselves, okay, your underlying profits came in ahead of forecasts at $2.35 billion, which was only a modest decline from a year ago. But a 4% increase in dividends, $750 million share buyback, and net debt is only down modestly from where it was in Q2 to just under 27 billion in Q1. So it's down 26 billion, but it's still above 3.5 billion higher than it was a year ago. Yeah. And yet here they are telling us that they're going to get it to between 14 and 18 billion dollars by 2027. How?
Well, this is it, isn't it? And I mean, I think going back to what we were saying about Amazon and Apple, where it's hard to sort of discern the true market reaction. You've got two catalysts offsetting each other, where you've got those earnings and that discovery. And I agree. I think we're up 6% or so over the last week. That's probably because of that discovery primarily. I mean, the CEO said, accompanying that earnings report, we know there's much more to do. Well, we all know there's much more to do, mate. You need to stop running around going, we're launching new reviews and we're cutting headcount here. Actually do some of this cost cutting, actually show us some cold hard facts, and then investors in general, including Elliott Asset Management, who are obviously involved in the firm, may actually be somewhat more, one, reassured by that the plan is working, and two, have more faith in the business going forwards. Because I think at the moment talk is cheap, but the figures just aren't delivering what's promised.
Yeah, I mean, the CEO said that he and the incoming chair-elect, Albert Manifold, who starts on the 1st of September, will conduct a thorough review of the portfolio of businesses in the coming months. Well, that's welcome, but why wasn't the review started a year ago?
Yeah, I don't understand why you need a new chair to do that review.
Just do it.
We said probably on this podcast a year ago, saying Elliott have taken a stake, review the business, get back to oil and gas, go back to your bread and butter.
Yeah.
That's how you fix things. The fact that it's taken them, if you were being sort of perhaps slightly uncharitable, you kind of say, well, you've done nothing for the last 12 months.
Yeah.
You've literally wasted your time. And also there's these continued questions. I know we discussed it last week over the buyback. It's almost a case of they're doing it because they know that the market reaction will be so adverse if they dumped it. But you're looking to cut costs. Is spending almost $1 billion on buying back your own shares the best use of your funds? I'd argue it's not.
It's not. I mean, the fact that net debt is $3.5 billion higher than it was a year ago tells me that ultimately the company, it should be, shareholders need to be taken into account, but you also need a sustainable business model, and pushing your debt levels up is not sustainable, in my opinion.
Yeah.
At some point, you have to address that.
And the longer run way to take account of your shareholders is to place the business on a more sustainable footing and to maybe start paying down some of that debt, as opposed to, and cutting costs and doing all the other strategy stuff you've promised, as opposed to just buying back your own shares. I mean, I've always been slightly skeptical of buybacks. I just think it's a bit of a sign that the company in question is out of ideas.
Yeah, I do too. But shareholders seem to like it, even though that...
Indeed.
Anyway, moving on. WPP, we've talked about that. Obviously, it's worst performer on the FTSE 100 so far year to date. It's down again today, even though the numbers have just basically reaffirmed what we already knew. 7.8% decline in revenue. Operating profits down 48%, struggling to adapt to new advertising paradigm that favours Google and search. So another multi-year low for the shares. New CEO's got his work cut out.
Yeah, certainly seems so. And well, we discussed this on the podcast recently, so we don't need to go into too much detail. But I'll just say again, I would not want to be that new chief executive, to be honest with you.
It's an uphill battle, I think.
Yes.
Diageo, Guinness, seen a really decent rally in the shares in the past 3 days. 27.8% decline in operating profits, but we are rebounding off 9-year lows. So perhaps the bad news is in the share price, and perhaps we could well be overdue a little bit of rebound. I mean, to be fair to Deborah Crew, who's departed, when she took over, they were already on a downward track, and maybe the new CEO, interim CEO, is going to reap the benefits of all the work that she put in terms of cutting costs, cutting inventory, and trying to build up margins. Any thoughts on that? Because at the moment we've seen a decent rebound. Perhaps we could well see further gains.
Yeah, I think that's distinctly possible. I mean, as you said, we're trading at almost a decade low. We're kind of probably now past that point of peak pessimism in terms of the share price. And if they continue to sort of turn things around, then you would hope that the share price will follow suit. I did think it was quite interesting, when you look at the breakdown of those sales, where the growth is coming from, because it's all coming from tequila and Guinness. So I don't know what that says about the global economy and sentiment and how people are feeling, but there we are.
Hey, well, you know what they say. Sometimes the world looks a lot better from the bottom of a pint glass.
Well, if you're having a pint of tequila, you'd struggle to see anything, I think.
Well, I was sort of thinking in Guinness terms, not tequila terms, but hey ho. So anyway, back above 20 quid. 200-day moving average is around about £22. Certainly would look to see a retest of those levels and the highs that we saw in April, May. So I think momentum does appear to be in its favour
Yeah, certainly seems so.
on a particular one. Intercontinental hotels shares are up 7.5%. Again, I'm looking at the numbers for IHG. An 8% increase, $2.5 billion. This is a franchise operation, obviously, because
Yes,
it operates hotels on a franchise basis. Emerging market, EMEA, Europe, Middle East and Africa, rose 4.1% revenue per room. Decent rebound there, though China was down 3.2%. But you've got a company that's increasing the dividend. You've got a company that's increasing or basically implementing a buyback, and it's 47% increasing. But you've also got a company that's seen its net debt increase by 21% over the course of the last 12 months. It's not a sustainable business model, really. And that net debt increase is basically shareholder payouts.
Yeah, and that is worrying, and it's not something that, as you say, it is unsustainable in the long run. I think the other positive when it comes to IHG is the commentary that they offered around those earnings, where they've said that uncertainty around the outlook is lifting, and they've reiterated their annual guidance, which has probably helped things along somewhat. But yeah, I mean, the short term reaction has clearly been a positive. The longer term one, you'd question that, and again ask, similar to what we were saying in terms of BP, how or indeed are you going to address the net debt going forwards?
Yeah, I mean, as I say, it's not a major concern now. But given the increasing concerns about the economic outlook, the hotel's expansion plans, one has to question whether ramping up net debt levels is the best use of cash on a longer term basis in a global economy that could well be on the cusp of a little bit of a slowdown.
Yeah, are you just sort of weighing yourself down with increasing levels of debt and increasing cost of debt as well? And is that going to pose a longer term issue to the firm? I think that's really the question to be asked.
Okay, let's finish off with Disney and Uber. Disney's results, a little bit underwhelming. Did see a lot of activity yesterday in the aftermath of those results, but the shares still fell to 2-month lows. But the company raised its full year profit forecast. So on the face of it, raising the forecast and the shares fall sharply. I'm trying to make sense of it to some extent.
Well, it must be that people listened to our podcast last week and heard your criticism of the shows that they're making and decided that that's the headwind that they need to sell the stock.
Indeed. I mean, as you would expect, the Parks and Cruise division performed well.
Yeah,
revenues of over $9 billion out of a total of $23.65 billion. But the entertainment division was the weak spot, as I suggested it probably would be.
Yeah.
An $179 million decrease in operating income over the quarter, which was primarily driven by a $275 million decline in content sales and licensing during the quarter. Now, Disney blamed tough comparatives due to the strong performance of Inside Out 2 a year ago. But I'm sorry, that's just nonsense, because you've had some really significant releases over the past quarter: Lilo and Stitch, Snow White, and Thunderbolts, all of which potentially could have been big revenue earners for you and would have allowed you to more than outperform Inside Out 2, which is one film. And the poor performance of 3 films still hasn't been enabled Disney to generate an increase in operating income. And that for me is a big, big red flag.
Yeah, it feels like an excuse and not a very good one at that.
And then you got Fantastic Four in Q4, and initial box office returns from that also don't look particularly appealing either.
Yeah, they're going to have to pull a bit of a rabbit out of the hat somewhere there, because does not, things do not look promising on the content front. That's for sure.
No, they certainly need to turn that around. Uber, on the other hand, decent set of numbers. Gross bookings up. rides up. The shares, again, quite choppy in the aftermath of the numbers. I think they implemented, did they implement a buyback?
Yeah, 20 billion.
20 billion, that was it, yeah, $20 billion share buyback. And their guidance was fairly positive as well. Just shy of $50 billion on the upper end of guidance for Q3, 23.76 billion in mobility, 21.73 billion in delivery. So fairly even split when it comes to rides as well as deliveries. So certainly the business has certainly come a long way from the loss-making machine it was a few years ago.
Yeah, I mean, I remember, we were all talking about, are Uber going to ever make a profit? Well, I think we've answered that one resoundingly at this point. And yeah, very solid report, everything moving in the right direction, guidance upbeat, and tripling the buyback. What is not to like?
Indeed. And I almost forgot this one. Travis Perkins.
Oh, we can't forget that. We'll
Can't forget that.
got our videos, haven't we?
We have.
TikTok.
3 days of solid gains for Travis Perkins shares, despite reporting a 2.1% decline in first half revenue to £2.3 billion. They're going to be CEO-less until 1st of January when Gavin Slark starts. But the sale of Staircraft has helped reduce its net debt by £88 million. Operating profits also rose by 11 million. So that's a sign the company is addressing some of its underlying issues. Toolstation operation has continued to perform well. Operating profits rising 21 million, a 50% increase. Full-year guidance was kept unchanged, and I think that was probably treated or greeted with a sigh of relief, and that's why the shares are up from the levels they were at the start of or the end of last week.
I would agree with you on that. I think it's very much a case of reiterating that guidance has given people a little bit of confidence that things aren't necessarily going to get any worse than they are at the moment, which is why we've seen that positive market reaction.
Yeah, I think that's probably right. So I mean that's basically this week. Let's look at the week ahead.
Where do we start?
Second quarter GDP. I don't have high hopes for this number.
No,
we got off to a really strong start. Well, I say really strong start. It's all relative. In Q1, a 0.7% increase in economic activity, but a large part of that was due to a big surge in exports of 3.5%. And obviously we had the government talking up the UK economy as a consequence of that. And I said at the time, yeah, fine, take credit for it. But what are you going to do when that basically completely reverses in Q2? Because obviously the surge in exports that we saw in Q1, we're not going to get in Q2 because an awful lot of the reason for that surge in exports was front running of the April 1st tariff deadline.
Yep.
Since then, obviously we've had the national insurance increases. We've had the increase in the minimum wage levels, but we've also had new packaging rules for retailers, which has obviously increased their overheads as well. And certainly when you look at services, which was a big plus in Q1, recent PMIs don't paint a particularly positive picture. So I think it's really a question of, do we see a slowdown? Yes. Do we see a contraction? Discuss.
Well, I mean, there are no forecasts or consensus for the data just yet, but I would not at all be surprised to see the economy contracting on a quarterly basis in Q2. I mean, you think the number of headwinds that the economy was facing, a lot of activity was pulled into the first 3 months of the year, as you alluded to, in terms of tariffs, also in terms of house purchases ahead of the stamp duty changes, the labour market ahead of those national insurance changes. And then you look at the data that we've had. It's been grim, frankly. The economy, month-on-month GDP is very noisy, but we contracted in both April and May in terms of GDP. The PMIs have been hovering around the 50 mark for a number of months now. The manufacturing sector well below.
I think we've got June GDP next week as well.
We do, yeah, at the same time. Yeah. Retail sales fell by, as near as makes no difference, 3% in May and barely rebounded in June. So consumer spending is starting to splutter a little bit as well. none of this looks particularly promising for a solid GDP number. Although what I would say is I would sort of prefer and to do what Fed Chair Powell is doing, which is to look at H1 as a whole, because then you take out a lot of that skew that we've just alluded to. But even then, I don't think he's going to paint the prettiest picture of the UK economy.
No, indeed, and I think that's the worry going forward, and I think that's probably one of the reasons why the Bank of England decided to just get a cut in now, before they come revisit the economy at the next meeting when they come back in September, I think.
Yeah, although again, the BoE are in such a bind with everything that we discussed previously that there's plenty of moving parts on that front. And of course, speaking of that, we may as well move on to the jobs data that we get out from the UK next week
for June. Yes, 3 months to June. Okay, what are you expecting, Michael?
Well, I mean, I think we're expecting more of the same. Ultimately, I think earnings growth will continue to cool, but at a very slow and sluggish pace. Unemployment will at best stay at 4.7%. At worst, it will rise further. I think the thing I'll be looking at most closely, given the data quality issues, but also the timeliness of the data, is the PAYE payrolls metric. That's obviously fallen for 8 months in a row now, basically every month since the budget last year. So I think the thing we need to look at now in terms of the UK labour market is, when are things going to bottom out, or are things going to bottom out, perhaps more accurately? Are we getting close to a point where businesses have made the necessary adjustments to headcount as a result of these national insurance changes, that the pace of layoffs may now be starting to slow, or even businesses may be starting to hire again? However, on that note, I wouldn't be particularly confident, because the PMI numbers that we had out of the UK, the July PMI data that we had, pointed to further job losses in the month of July. So I would not be particularly confident that we are bottoming out anytime soon.
Yeah, and I think, we're in the middle of the school holidays at the moment. And I think one of the things that, when I was a kid, when I was a teenager, I used to get a summer
Black
job.
and white television and all that.
So funny. But I mean, summer jobs were the really big thing, where basically you did a summer job to basically help generate a bit of income in the fallow period, between, especially when I was in my 6th year. Studying for my A-levels, I was reading earlier this week that employers won't take on holiday hires.
Yeah.
Because it's just too expensive to do so. Minimum wage, obviously national insurance contributions, and you've got all these graduates, these students and what have you. They're looking for something to do over the summer holiday. And employers really aren't interested in taking them on, because it's just too expensive for them, So I mean, and that was I think that was one of the key things that I took away from my teenage years, was the ability to earn a little bit of extra money to help supplement any sort of spending that I wanted to do over that period, but also to help to sort of fund my own sort of summer holiday. Now you've got students and teenagers nowadays, they can't even do that because businesses' hands have been tied up in so much red tape that they just don't want to do it.
Well, that's the issue. It's not only cost, but as you rightly say, it's also the red tape and the regulation and everything that goes with that, which just means businesses kind of turn around and go, well, it's not worth it. No. It is literally just not worth my time in taking temporary staff on, or young staff on, or whatever it may be. And that's not only having an economic impact now, I think it will have a sort of social impact longer term, because people won't have that introduction into the world of work and earning a living and budgeting and all that kind of stuff that we take for granted. Yeah, exactly.
The soft skills that you learn from interacting with other people, different people, not just your schoolmates, but pretty much across the whole societal, the whole of society. You speak to people on the shop floor, you interact with customers and what have you. That was a key element in terms of me building up my social skill set, outside of the classroom. And I'd had a paper roundup at the age of 12, finished that at 16, 17, doubled that up with a Saturday job and a Thursday night job at, sort of a supermarket. That's a huge learning curve that youngsters of today are finding it increasingly difficult to tap into. Anyway,
I fully agree. We better move on before we
Yeah.
descend into a rant, because
Yeah.
US inflation out next week as well.
Yeah. I mean, does that really matter? I mean, Trump's still banging on about how Powell is a moron, Powell is this, Powell is that. Ultimately, whoever is head of the Fed, whether it be Powell, whether it be Hassett, whether it be Waller, whether it be whoever, will still have to carry the rest of the board with them when it comes to a rate cut.
Yeah, I do think that CPI does matter, primarily in the context of the jobs data that we had on Friday. Last Friday, I should say, because markets have, since that non-farm payrolls number, basically gone all in on the idea of a 25 basis point cut in September. I think that's priced at about an 85% chance right now. Yeah. We've even had some, I'm going to say it like it is, idiots on the sell side calling for intermeeting rate cuts or 50 basis point rate cuts, which is just complete and utter nonsense. But the reason why I think CPI is important is because obviously in the June data, we started to see the first effects of tariffs showing up in terms of price increases, particularly in that core goods inflation metric. And the second reason why I think it's important is because in the commentary that we've had from a number of Fed officials since the July jobs number, the majority of the committee, excluding Waller and Bowman, of course, have been saying not only that they still view a patient approach as the right approach, but they've also been saying that the inflation side of their mandate is further from its objective than the employment side of their dual mandate. Now, I think the CPI numbers are very, very important in that respect if they start to tip the balance in favour of the risks to each side of the dual mandate being a little bit more equal, which could in turn then firstly open the door to Powell being a bit more dovish at Jackson Hole at the end of the month, and then potentially to a cut at the September meeting. But if we get a hot CPI number, up towards, if not above 3%, then I would argue the Fed will find it quite difficult to cut rates in that sort of an environment.
Yeah, I would agree. I mean, we've seen it. US CPI go from 2.4 to 2.7% since April. Food prices in the US are doing what they're doing here in the UK. They're rising above the level of inflation, 3% in June. So it'll be interesting to see whether or not we see further gains. So essentially, US consumers are facing the same sort of income squeeze that we're facing here in the UK.
Yeah,
only on
absolutely.
a slightly smaller scale.
Yeah, fully agree.
Okay. Earnings, fairly light on the earnings front.
Yeah, we're sort of getting towards the end of earnings season now, aren't we?
Yeah, we are sort of, yeah.
Certainly stateside.
Yeah. We've got Balfour Beatty, which again has done really, really well so far year to date, UK construction giant. I'm old enough to remember when there was concerns that was going to go bust along with Carillion back in 2014. But Leo Quinn, when he took over back in 2014, has really turned this business around. It's trading at record highs, another good year. Solid set of full-year numbers back in March. Annual revenues of over £10 billion, raising the dividend. They're getting a new CEO. And I think there were concerns that the new CEO, might undermine the legacy of Quinn, but certainly there's no evidence of that thus far. So expectations fairly high for Balfour Beatty.
Yeah, indeed. And that's quite a turnaround story in terms of the company, isn't it? From near bankruptcy to where they are now. So, yeah, I think those results are going to be very, very interesting indeed.
Yeah. So signed, most recent contract was an 833 million net zero Teesside contract to construct a large-scale combined cycle gas-powered generation plant for net zero Teesside, along with BP and Equinor. So that's
zero. We're getting into dangerous territory now.
We are. Are we near the top? So Balfour Beatty, definitely worth checking those numbers out. But certainly the new CEO's got some big shoes to fill when he takes over. We've also got Persimmon, which will be a fairly decent indicator of the UK housing market. Traded sideways for most of the year. Construction PMI this week, Michael. Oh my God. I mean, that was a dreadful number. And most of that was down to a collapse in residential housing.
Yes, absolutely. I must admit, I was too busy driving an Aston Martin to actually look at the construction PMI yesterday. Sorry, I had to drop that in.
Were you able to get in and out of it okay?
You'll have to wait until you see the video.
Yeah, I bet that video never sees the light of day.
Not if I have a say in the matter, that's for sure.
Okay, so we've got first half numbers from Persimmon. So I think that'll give us a broader indication of forward bookings, I think, is the key metric here.
Yep.
Persimmon posted a fairly decent set of numbers. Private forward sales are up 17% in the 3 month in the period to May. The big question is whether that demand for housing is holding up, because certainly I think what we're seeing in some of the stats and the construction PMIs suggests that house builders are very reluctant to engage in large scale building projects, despite this government's promise that it's going to build 1 million new homes. I don't think they get anywhere close to that.
No, and frankly, they can't. If for perfectly valid reasons the house builders don't want to engage with that, then there's absolutely no chance the government going to get anywhere near their target. But
they need to make a profit, don't they?
Well, exactly. They're not charities. They're only going to build if they're confident that the demand will be there when the houses are finished, and that clearly is not necessarily the case at this moment in time.
And finally, Cisco Systems fourth quarter numbers and Deere third quarter numbers, the agricultural equipment maker.
Yes.
So, I mean, briefly, Cisco Systems, it's the architecture basically on which AI systems run. Seen some fairly decent gains for Cisco. They appear to have lagged the broader market, the chip makers and what have you. But maybe this is another AI play that's sort of gone under the radar somewhat.
Yeah, I think it may well have done, because by far from an expert in all of this sort of stuff, but as you rightly say, it's the architecture that underpins all of this. Yeah. And so far, we talk about sort of picks and shovels quite a lot around here, around chips and the companies like ASML that make the machines that make the chips and all this kind of stuff. But what about the networking that goes behind it? And Cisco are very much at the heart of that.
Yeah, I mean, and they were saying in Q3 that AI orders accounted for $600 million in infrastructure. Well, they generate $14.6 billion in revenue. So AI infrastructure, 600 million is not a particularly big amount. So you would think that number is only going to go up.
Well, I was going to say, you'd imagine that number is not only going to go up, but go up quite significantly, given how much AI capex is going on elsewhere. I mean, that's one of the other things that we learned from all of the mega cap earnings. Capex is only going one way. That's going to filter on and have a positive effect on a lot of the other stocks, such as Cisco and all the other chip makers and all the rest of it.
Yeah, so I mean, basically, it should reap the benefits as companies upgrade their network infrastructure to cope with the additional payload of AI.
Well, if they don't reap the benefits, they're doing something wrong, I think.
Indeed. Agricultural equipment makers, Deere, again, Q3 on the 14th, posted a little bit of a slowdown because farmers were choosing to rent and not buy because of lower crop yields. But they are looking to spend $250 million in upgrading 3 of its manufacturing works in Iowa to try and get round tariffs.
Yeah, which almost takes us full circle back to what we were discussing with Apple, where we're seeing companies boost investment in the US effectively to try and get carve-outs from tariffs. So yeah, I think it'd be interesting to see what they have to say in terms of that, and also the impact it might have on any guidance that they issue as well.
Indeed. Okay, so that's pretty much it for this week. We're coming under the hour, so that's good news. Once again, thanks very much for listening to our collective musings, and I look forward to seeing that video, Michael. Until next week.
Yeah, don't hold your breath.
Yeah, I have a feeling that might suddenly find its way into the weeds of the internet somewhere.
I certainly hope not.
Anyway, thanks again, and we'll speak to you same time, same place next week.